There's no chance for the S&P 500 to do well. And we just spent the last 30 years teaching people that's all you've got to do. All you got to do is just buy the S&P and you're going to get rich. I don't care how profitable, how exciting they get for a year or two. It's a virtual guarantee that they're going to crash and burn at some point in time, because they always do. That's just the way it works. No one has any idea whether they're going to monetize some of this stuff. The people that think if we settle up with Iran that the price of oil is going to go back to $60 a barrel, they're either drinking the wrong thing or smoking the wrong thing.
We're coming to the end of an era of extremely low interest rates. Additionally, valuation metrics across almost all financial systems are at near mania levels. Historically, this has never been a good combination. Is this time going to be any different? Let's find out. This is the warning, the stock warning from our next guest, Bill Smead, founder and CIO of Smead Capital Management. This video is sponsored by Kalshi, the largest prediction market in the United States. Unlike a sports book, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan the QR code here to get started and use my code LIN, L-I-N. When you use my code, new traders can get $10 when you deposit $10. Right now, traders are predicting that there's a higher than 50% chance that crude oil WTI, will end the year above $115. Now, higher oil is central to the thesis that we'll be talking about with Bill. This is going to cause tremendous destruction. So stay tuned for Bill's response and analysis and his projection on oil. And in the meantime, link down below for Kalshi. Thanks so much for joining again, Bill. Good to see you.
Thanks for having me.
You've made a number of correct calls on my show last year, including calling for energy to go much higher. So we'll revisit that call. But first, I want to talk about your core thesis for why things are about to move the way they are. So why are we entering an era where yields are going to go much higher? Let's start with that.
Well, yes, starting there, it's I wrote a piece this week. They've been running the mac and cheese commercial for Kraft, the Kraft mac and cheese, the best thing ever. Well, I came into the business in 1980. In 1982, the market traded at 6 times earnings and was paying a 5% dividend. And interest rates were 14, 15% on 10-year treasuries and higher on corporates. So the best possible thing that can happen to the equity owner is to start out with incredibly cheap stocks and then have interest rates go down from 1981 until about a year or two ago, probably bottoming in 2021. So for 40 years, interest rates went down and you started out with as cheap as stocks ever get. And unfortunately, we're now at the process of going back to normality, which is interest rates that settle into something closer to the average of the last 40 years, and stocks having to be repriced against that more typical interest rate.
We're speaking on Friday, the 5th of June, and it looks like everything's selling off right now. Headlines tell us that Broadcom sell-off may have something to do with it. Now, is this the beginning of your thesis playing out, or do you think today was just a matter of profit-taking? And this is just not just stocks, by the way. It's also gold, a little bit of oil. Bitcoin's down 6%, 5.5% now.
Well, it started about 3 or 4 weeks ago when I was in New York. What's happening is the market just kept getting more narrow and more narrow and more narrow. And back in the old days, when there actually were lots of active managers and there were lots of research people that catered to active managers, there was a saying that when the generals are marching forward and the troops aren't following, you know what's going to happen to the generals. And what happened to the generals is now the generals are getting slaughtered.
Right. One piece of news came out today, which is the jobs numbers. Growth unexpectedly beat expectations. So we had non-farm payrolls jumped 172,000 for the last period, down slightly from the upwardly revised 179,000. This is still above the Dow Jones consensus estimate for 80,000 by a long shot. The unemployment rate held steady. So today's jobs numbers really beat expectations out of the water. Do you think the signals are more hawkish Fed? Is that why everything sold off?
Well, it's so interesting. The federal government is basically spending money still like drunken sailors on leave. And then what's happening is there's this mad dash to get on top of the AI space race, right? The race for the gold ring in AI. And so that creates a tremendous amount of economic activity, right? When people are pouring billions and billions of dollars, the big FANG stocks are all spending all of their profits in capex. Now they're not running it through the income statement as a current expenditure. They're doing it on a depreciated basis, but neither here nor there. What made them great was they didn't have to invest a whole bunch of new money in what they were doing to dominate search or to dominate social media or to dominate the software business like Microsoft. So they've completely ruined those stocks as a safe haven because they are now vulnerable. And then this whole chip thing, it's the most cyclical industry in my career, right? I'm 46 years as of June 2nd in the industry, and the most cyclical business in our industry is the semiconductor business, the chip business. So I don't care how profitable, how exciting they get for a year or two. It's a virtual guarantee that they're going to crash and burn at some point in time because they always do. That's just the way it works. Because the problem is there has to be money made from the capex spend, and no one has any idea whether they're going to monetize some of this stuff. Usually what happens is 3 out of 20 companies that do it end up monetizing it, and the other 17 go squadouche. That's what happened with fiber optics and Lucent and all those goofy companies back in the telephone oriented stuff back in the dot-com bubble. So it's the same song played in a completely different set of circumstances, which makes people think it's different this time.
Maybe, can we just challenge ourselves? Maybe it is different this time. Maybe chips are so integrated into everything that we do versus before when they become more cyclical, that they're no longer cyclical. They're more of a defensive staple. They're a necessity. They're the new oil. That's the thesis here.
You mistook what I said. It's always different this time.
Yeah.
I'm not saying it's not different this time. It's always different, but it rhymes with the other manias, whether it be railroads or radio in the late 20s or the go-go companies. Remember, just think of the parallels. We got really jacked up about growth stocks in the 60s because we won the space race. We walked on the moon before the Russians did. That was a psychological victory of freedom versus communism. And it's like, hey, so everybody just went crazy on growth stocks in the mid to late 60s. Okay, well, that was a bad idea to get caught in that. Buffett closed his partnership in early 69 within 6 weeks of T. Rowe Price opening the T. Rowe Price New Era Fund to own commodities, oil and gas, and hard assets, and gold. So the smart guys were getting the heck out of the market when we landed on the moon. And now people are just getting ready to put their money onto SpaceX to be taken to the moon. So again, it's always different. Each set of maniacal behaviors are wrapped around a completely different set of circumstances, but the rhyme is what you have to understand. It is mania. It is absolute, total maniacal behavior. Now, that's the bad news. The good news is that's going to ruin the market for about 60% of the stocks in the S&P 500 index, but it's actually going to be the first time in quite a while that people were interested in the other 40%. There's 200 companies in the S&P 500 index that don't have anything to do with all this, and actually somebody might show some interest in owning their stock.
This is an interesting finding. This is from this is a report from Bank of America. So chief investment strategist Michael Hartnett put out this note. Just 21 stocks, about 4% of the index, are currently making new highs. At the dot-com top in March 2000, the number was 20. And so the comparison is striking. The S&P, as tracked by the Spider Trust, continues to notch new fresh records. What do you make of this comparison here?
Well, no, it's terrific because it shows that it is different. It's chips. It's not fiber optics. It's not the internet will change our life. It is AI will change our life. So that's the difference. But the rhyme is it's the same kind of mania. Is there gold in them hills? And the answer was yes. But a lot of people died trying to find it on their way across the country before there were railroads.
What would you say to somebody who wants to get in on the SpaceX IPO, or perhaps just ride the tech rally some more, and he's brushing off some of these concerns that you and other economists and investors have talked about, which is that valuations are near mania levels, but their response is, well, I've heard that valuations are high for many years now, and look where we are. So I'm going to ignore these warnings and just continue buying and maybe get in on these IPOs. What would you say to that person?
Well, two things Buffett used to say. He says, it's like that person is like Cinderella at the ball. She knows, she's been told by other people that when the clock strikes midnight, it's all going to turn to pumpkins and mice. But she shows up at the ball, and guess what? There are no clocks. She has no way of knowing when the clock is going to strike midnight. So here's the problem. The problem is Jeff Bezos was on the cover of, Time Man of the Year, Person of the Year. Time Person of the Year, December 27, 1999. And his stock was the hottest stock in the mania and the dot-com bubble. And a year and a half later, that stock had declined 85%. Okay. The 9 people that created AI were named the Time Person of the Year. Okay. Around December 27th just passed. And guess what's ready to happen to them? The same thing that happened to Bezos stock. Now, was Bezos hugely successful? Yes. Did anybody that buy it before it and own it while it went down 85%, did any of them stick around? The answer is no. It was a completely different set of people that made the money on Amazon. You could have waited 10 years and bought them and made a ton of money. Or you could get in early like these people are right now on the AI thing and get your head beat in and then do so poorly that you won't be around to make the money.
Some people say that if you buy into any of these IPOs, your exit liquidity for the venture capitalists who already got in before you. Is that true?
Oh, of course it is. It's the unknowing public getting punished for their enthusiasm.
Yeah. So this is a chart of this compiled by Reuters. SpaceX multiples defy gravity. Price to forward revenue, price to forward EBITDA. Here it is versus Tesla, Palantir, Nvidia, and the NASDAQ 100 mean. Now, recall that Tesla also was pre-profitability when it IPO'd years ago, and it still was one of the top performing tech stocks in the last decade. So I have to draw that parallel. What do you think?
Well, we do a lot of reading. We have our own podcast,
Sure.
The Book with Legs, that Cole runs. And I read Walter Isaacson's book on Elon Musk. And then a month later, after I read that book, I went to a lunch that my buddy Bill Way does to support the arts here in Phoenix, called the Celebrity Lunch. And the celebrity was Jim Cantrell, who was the guy that helped Musk start SpaceX. He took him to Russia to buy Russian capsules or, whatever you had, rockets. You had to go to Russia to buy pre-made rockets. And so I said to him, I got 3 questions for you about Musk based on Isaacson's book. True or false, Musk is a genius? Jim Cantrell's answer, true. True or false, Musk is insane? Cantrell, true. True or false, Musk has demons? Cantrell, true. Okay, so what's the point? The point is that his genius has been maximally priced, and his insanity and his demons have not caught up to it yet. Okay, and let me tell you, the market will be that will be, that's Lucent Technologies was loaning the money the last year. In 99, 45% of their revenue came from loaning money to the customer. Okay. In other words, they were phantom sales. They weren't really sales. They loaned money to the customer to buy their product. And think of the core weave and all this incestuous, oh, you buy my chips, I'll do this, you do that. It's going to be a hot mess when it plays out.
So I take it you're staying away from tech. Do you have any holdings that you're willing to pair off or rotate out of, or are you just staying out altogether for now?
Let's see. I can't tell you what we've done during the quarter, but let it be said that we hardly had anything in tech, and you can probably imagine what we've done with it during the quarter.
Fair enough. This is your Smead Value Fund A. So this is what you've reported so far in 2025. Last year, you trailed the S&P 500 total return index, but year to date right now, you are beating the index. Without disclosing what you've done last quarter, can you just tell us roughly what's changed, or any change in strategy or tactical shifts in your positioning?
Well, let's see. We have been adding to things that seem to be the most depressed by the way capital is being allocated right now. So if you just went through our portfolio and said, which of our stocks have been doing the most poorly, we've had a tendency to be adding to things that got cheaper. Here's the interesting thing. Everybody asked me, said, well, Bill, like they're worried about interest rates today, right? Because the jobs report was strong, so they think rates are going to rise. And then everybody asked me, well, Bill, is there anything that could stop the interest rates from rising? And I said, well, that's simple, because the answer to that question is, why did Willie Sutton rob banks? And the answer to that is because that's where the money is, right? So think about it. Isn't it ironic that as SpaceX goes to go public, and what is it? Which one is the other one? Is it Anthropic or the other one that's going public? Is it Anthropic? Anyway, as these get ready to go public, where is the money going to come from that goes into them, considering that most tech investors are not only fully invested, but they're probably, a lot of them are using margin, and they're way over their skis and margin debt on top of that. So where's the money going to come from to buy SpaceX? Well, the answer is it's where the money is right now. And where the money is, just like you showed in earlier, 21 stocks have most of the money that's in the S&P 500 index. So to get money, that's where you got to go. So I was going to answer a question earlier in our talk. When I came in the business, stocks were hellaciously cheap and interest rates were very high. And I would cold call, as a young stockbroker, business owners. And I'd say, if they were willing to talk to me, I'd say, well, what have you been investing in? And they'd say, well, I own the building our business is in, and I own 3 rentals, and I own some gold stocks and a couple of oil stocks. And ironically, there will be a pivot back toward home ownership once the people that are currently 20 to 50 get burned on these stocks. It's going to give them a new appreciation for either owning a home. By the way, having someone offer you 30-year money with tax-deductible interest is the most likely way to accumulate wealth in the United States of America. Nobody gives you a 30-year mortgage to buy a common stock.
If we have the end of a secular bull run in bonds because interest rates are going up, does that mean the end of secular bull run for homes as well, if mortgage rates follow upwards?
That's a great question. By the way, if they crucify the AI stuff like I think they're going to crucify it, and the tech stuff like I think they're going to crucify it, that'll help move rates down, because there will be a huge flight to safety. The first reaction when it's obvious that the game is over will be the flight to safety. But you're thinking longer term, and I'm fine with that. Longer term, in the 1970s and early 80s, the most homes we built divided by population in U.S. history. Are you ready? 1972, 1978, and 1984. Rates were moving up the whole time, but inflation peaked at about 11%. And so if somebody would loan you money at 9% tax deductible to buy an asset that was going up at 11%, at inflating by 11% a year, you were happy to do it. In other words, owning a home was the asset of choice, and owning rentals was the asset of choice of 60 to 80-year-olds at that time, because stocks were terrible. And we just haven't seen that for a long time. So how could stocks get terrible? Stocks could get terrible in general if rates rise and inflation is a problem. And those jobs numbers today reminded people that inflation could be a problem. And by the way, the people that think if we settle up with Iran that the price of oil is going to go back to $60 a barrel, they're either drinking the wrong thing or smoking the wrong thing.
Is inflation going to be a problem because of Iran and the Strait of Hormuz closure, or because of fiscal irresponsibility by the government?
Too much money chasing too few goods is almost always the main reason for inflation. Too much money chasing too few goods. So the answer is there any effort being made for the federal government to balance the budget? No, there's no chance of that. Does the demand for data centers do anything but cause inflation? The answer is no. That's all it does. It's just a lot of inflation. TSMC is building a massive facility out in the northeast part of our area here in Phoenix. It's just gigantic. It's the biggest building I've ever seen in my life. And I'm 68 years old. And just think of all the economic activity associated with that, right? It's just crazy. A lot of workers getting paid well, a lot of borrowed money, et cetera. No, it's a hot mess.
Okay, I want to shift gears now to energy. Talking about things that were not overvalued. This is from Cowsheets, a prediction market. How high will oil WTI get by the end of the year? Is oil, and by extension oil companies, still fairly valued today at close to $90 a barrel? I'll start with that first.
Well, they're very undervalued compared to 90. The market is pricing them at 70, and President Trump still has dreams of 60. So we ran numbers 6-8 weeks ago and just said, okay, if a year from now, if at the price of oil, what would the free cash flow be for Apache, or what would the free cash flow be for Oxy, or what would the free cash flow be for Synovus, et cetera? And the numbers are really outstanding. It means there's really good value in the stocks here, even though they've run up at $70 a barrel. Well, at 90, I mean, these people they're making a year's worth of money in 90 days.
Yeah.
Right? A year's worth of money in 90 days. And so what are they going to do with that? Well, they're going to buy back their own stock, because what they've all done, they've all got fiscal discipline and shareholder interest in mind, because they're just so glad that people have given them some confidence in the last year when things were terrible. So the answer is, the next thing, you're going to start seeing the consolidation in the industry, right? We own Apache and Oxy, and we don't understand. We're glad they haven't been bought out yet, but we don't understand why some of the big people aren't buying them, because you've got to make sure you've got all the oil you're going to need to provide for the next 10 to 20 years. And the easiest way to do that is to buy somebody that's already got it.
And by the way, traders are still quite bullish on prediction markets. They're predicting 60% chance, almost 60% chance of $115 or above by the end of the year. Most of the probability curve lies above 115 for this particular trade. I wonder why the S&P may not be pricing this in already. One of two reasons: one, higher oil doesn't actually hurt stocks in 2026, or two, the markets don't believe that higher oil is here to stay, given that prior geopolitical shocks have usually led to rising oil and then retreating prices very shortly after.
The correction in the oil stocks the last 6 weeks, I think, had more to do with fears of demand destruction. So I actually think it's probably preferable for the oil companies for it to settle in at 80 to $100 a barrel for an extended period of time, and then you won't get as much demand destruction.
How much higher does oil need to get? I mean, nobody knows before we see demand destruction, because I've read and heard from several people that we are less reliant on energy today than 40 years ago, and so the sensitivity to oil shocks may be lower now. Do you think so?
Well, part of that is a affluent country snobbery.
Okay.
Where's most of the population growth in the world right now?
Africa.
Africa. You've seen a lot of charging stations there?
No, I'm guessing no. I haven't been to Africa.
I haven't either, but what I read says that there's not a charging station every 2 hours. Okay,
sure.
So there it's kind of wacky. I mean, the Chinese are, they've adapted for basically for military reasons, for using as little oil and gas as possible, but they still use a lot. Let's not kid ourselves.
Yeah.
But India, these other places, so the answer is, the demand for oil and gas is going to probably rise a little bit each year with the population of the world going up, and the sources of it are getting less and less likely to be useful. It's one of the reasons why we like Cenovus, because the Canadians have 25-year well life, right? They have long life wells. I like to joke that they have better dinosaurs than everybody else.
Well, you actually wrote this in a note. You wrote that we won't be returning to $60 anytime soon, contrary to what the administration may hope for, and perhaps sustained higher energy prices may damage the psychology behind 15 years of uninterrupted market momentum. Can you expand on that?
Well, yeah, you just never know what the trigger is going to be, right? And then the trigger comes, and people don't know that it's the trigger. Buffett says when the tide goes out, you get to find out who's swimming naked. And remember, you didn't used to be able to bet on sports games. You didn't used to be able to bet on prediction markets. You didn't used to get to bet on elections. And what it tells you is people are gambling in so many ways, and that gambling is completely infested common stock ownership. People are gambling, they're not investing. And then secondly, that has caused disordinate benefit to passive investing, right? There's been absolutely nothing to be gained from being active, and therefore the active community is almost completely gone. And that's who used to do the price discovery in the marketplace, was the active management community. Even though they disagreed with each other, they were doing price discovery. And so we feel like a bunch of kids in a candy store at our firm. It's like, wait a second. Buffett says the key to life is weak competition. Or as he like to say, I want to turn out for track, but I want the hurdle set at 1 foot high. So just think about it. The index has got 50% of its money in 21 stocks. If those go sour, the active guys are going to look like geniuses on days like today.
I want to turn to a few other sectors that you do like, but before that, one final question on valuations in general. So way back when I was in university, we were learning about finance and reading all these textbooks. We were reading about all these investors who favored best-of-breed businesses. Now, you had compared today's situation to the Nifty 50 parallel couple decades ago, when people bought the best businesses, but valuations were high and some of them collapsed. Now, that presents a challenge, because if business school students are taught that to get ahead, you have to invest in the best of breed businesses, but they're usually valued at a higher premium, what do we do? Now, this higher premium may be at a mania level. I mean, do we go to the second tier companies? Or?
Andy Grove was the CEO of Intel back in the 90s when it became a great company, or it kind of reached some of its earliest heights. And he was asked, what's the best advice you ever got in business? And he said it was his City College of New York professor who said, when everyone knows that something is so, nobody knows nothing. So there's two things that everybody knows now that they used to not know, and they all agree on. Everybody knows, and by the way, Jason Zweig at the Wall Street Journal has been the largest cheerleader for this, which is the low-cost passive S&P 500 index is the best thing you could possibly do. Jack Bogle was a genius. He looked at all the flailing that people did in the stock market. He said, let's give people just a basic way, low-cost way to participate, and it was genius. And then the second thing is Buffett and Munger taught everybody to find wide moat, high-quality, high return on equity businesses, and don't be too worried about what you pay to buy them. Those two things, right? Are you with me? Those two things. Guess what? There isn't anybody on the planet that doesn't agree with them. And once everybody knows that something is so, nobody knows nothing. In other words, that's not a good way to approach things. It's not a good way. Now, there are some high quality businesses that because their industry is so far out of favor right now that you can do that. We're doing some of that. We have 8 criteria for common stock selection. They're very qualitative in nature. So we're doing that. But that's a hard thing to find. Okay. And then secondly, the index has as much chance of making money in the next 10 years statistically as the man on the moon. If you go back and look at every time that the index is in the situation it is now, and then look 10 years later, 72 to 82, 99 to 09. You lost money. You lost money counting dividends in the index for 10 years. The chance of the index making money over the next 10 years statistically from historical, mathematical, Shiller, CAPE, GDP to stock market value, the Buffett indicator, I don't care which indicator they're all telling you the same thing. There's no chance for the S&P 500 to do well. And we just spent the last 30 years teaching people that's all you've got to do. All you got to do is just buy the S&P and you're going to get rich. And I can't remember reading that in either the Old or New Testament of the Bible, so I don't think it's probably true.
Do you still hold the mantra that all you have to do is buy the S&P and wait 30 years and you're going to be rich? I mean, that's what happened in the last 30 years.
It is, but remember, we started with the best thing ever. We started with hellaciously cheap stocks in 1982, with an interruption in 87, 06 to 09, and a blip. A 60-day blip in 2020 and a 78-day blip in 1987. It's the best thing ever is cheap stocks and constantly declining interest rates. Stocks are not cheap in any way of measuring them from a historical standpoint. When I got in the business, I think we thought the average historical multiple was maybe 13 or 14. And now that historical number maybe is 15 or 16. A lot of people think that 21 right now is fine to them. Well, not compared to history, it's not. Because when people get scared, they demand more for their money. And they haven't been scared for a long time. They've been taught to buy every dip.
Okay, so let's close off on some of the things you do like. Now, you were previously in large financials. You still like the financials, but I think you've pivoted away from some of these bigger names into the regionals. Tell us about that move.
Well, it's kind of odd because the thing we just talked about leads into that.
Yeah.
When the S&P turns sour, the financial advisors out there that have been getting paid really well without really having to have an investment opinion are all going to get weeded out. There's going to be, I hate that a lot of these are customers of ours and I love them dearly, but there's going to be the biggest shakeout in the financial advisor world. Remember all these private equity deals rolling up these guys, right? Merging. Barron's is now written to cater to financial advisors. right? They don't cater to stock pickers anymore because there aren't any stock pickers anymore. There are no active managers anymore. So now they're catering to financial advisors. Well, guess what? To get paid a lot of money to put people a big chunk of S&P 500 in there and tell them to sit on their hands so we trimmed our big guys that are more involved in the investment markets, and we have emphasized banks that aren't very much involved in the investment process. They're more just basic banks, deposits, and loans. And that's what you get from the regional. So that would be your Fifth Third that's made a very wise acquisition of Comerica. That would be Western Alliance that is growing organically across the country, and that's what we've emphasized because they're not very susceptible to a correction. If the stock market turns really bad for 3 or 4 years, it's going to cause the biggest correction in the financial advisor world that we've seen probably since certainly 06 to 09.
It's interesting you bring that up because once perhaps the markets return and people do want advisors, maybe they'll go to robo-advisors and AI companies will fill that gap. What do you think?
Well, they certainly won't be very anxious to whoever is leading lambs to slaughter right now won't be very popular. Let's just put it that way.
Let me close on this final thought. If you had to forward project multiple decades and think about some emerging themes that may be different in the next 50 years than the last 50 years, what would they be? A few come to my mind. First, declining fertility, which is something that reversed just a few years ago, if not the last 2 decades. The second is the rise, of course, of AI, and not just AI, but robotics, and declining workforce labor participation rate. Maybe those things are all interrelated, but I'll let you comment on anything else that comes to your mind.
Well, certainly anything that inhibits immigration is not there to offset the slowdown in baby production that had been in place prior, right? That plenty of people have been coming to this country to offset the fact that we haven't been having as many children. Now it's harder to get into the United States. So the answer is in our view as a business, it's a negative because the best thing for economic growth is more mouths to feed, more people to be housed. Now, that's the negative story. The positive story, for example, the home builders, is we're building homes at the lowest percentage of population of any time in the last 50 or 60 years, other than the depression in 03 to 07, right? 08. So other than that real estate depression, this is the slowest number of new homes built divided by population in the last 60 years. So there are millions, like 90 plus million people in each of the two groups, the ones that are like 40 to 25 and 25 to 10. There's a lot of people, and a lot of them don't have a house yet, right? So you see that the news today this week was that existing homes are being pulled off the market that were up for sale. Well, if you want a home right now, you got to go to somebody building it because the existing ones are being pulled off. And by the way, the existing homes are 45 to 50 years old. They need numerous trips to Home Depot and work done on the houses and so forth. So we like the home builders. You have to buy the home builders when there's no hope.
Okay.
Right? There's lots of people that don't have a home, but there's no hope. And that means you're getting low prices. What did Buffett just do this last week? He bought a publicly traded home builder, Taylor Morrison, for $8 billion or whatever it was. Okay? So we own Lennar, we own Horton, and we own NVR. And we think they have a bright future. And if stocks turn sour, wealthy people might own 5 houses that they rent instead of owning stocks.
So you're betting on wealthy people, I guess, older, more established investors buying these homes as opposed to the younger people, because a lot of people can't afford homes, like you said, and with the demand destruction that we're talking about today, I don't know if you think this is going to get any better for them.
This is the largest group of 60 to 80-year-old wealthy people in the history of mankind in the United States. Why not give your kids the money while you're alive and give them the money for the down payment? I mean, it's a no-brainer. It's a total. Now, I'm talking about people with, net worth at $1.5 million and above. But the stock market has made more of those over the last 20 years than we've ever had, by far. So give it to them. Give it to them while they're alive.
Yeah, give it to them while they're alive. And while we're alive, we want to follow your work, Bill. Where can we go?
Smeadcap.com. We write all the time. We podcast. We love doing your show. Thank you for having us. We're there. Go to our advice at smeadcap.com.
Well, we love having you on the show, so thanks for being here today. And yes, please do follow Smead Cap in the links down below. All right, thank you, Bill. We'll speak next time. Take care for now.
Thanks for having me. Yep.
And thank you for watching. Don't forget to like and subscribe. And don't forget to use my code LIN, L-I-N, when you sign up to Kalshi. New users who use my code will get $10 when you trade $10. Link down below or scan the QR code here.